Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin with our top story, a big sell-off in big tech, sending the S&P 500 to its worst day since December 22. Anastasia Amoroso of iCapital writing this. Tech consolidation and sell-off likely has more to go. Outperformance in terms of positive surprises led the significant Mag 7 stocks outperformance over the past year and a half. But it now may be coming to an end. Anastasia joins us for more. Anastasia, good morning. It's good to see you.
Good to see you.
What are we seeing take place here? Just a massive technical unwind of consensus positions across the board? Is it a growth scare, a rotation, a broadening gap? What is this?
Well, I think the technical backdrop is part of the story. And obviously, the technicals were very stretched coming into, I would say, June for technology shares in particular, whether you looked at positioning, whether you looked at the overbought conditions. Remember, we were the relative strength indicator over 70 for quite some time. So I think that explains part of the unwind. When you see a setup like that, you think, well, something's going to happen to take us down. But I do think also there's a more fundamental story here, which is the earnings surprises, as I mentioned. That's what really lifted the Mag 7 stocks higher. If you look at by how much they were beating expectations, that's one way to look at it. The rest of the S&P was not doing much, but the Mag 7 was doing a lot. The other thing to think about is how much were the earnings revisions going up for some of those technology stocks. And again, it's by a significant amount. That is not likely to be the case going forward. And case in point, Alphabet and Tesla did not see the positive surprises or saw a negative surprise. And to your point, the market is really severely punishing that. So you have lofty expectations, you have lofty valuations, and now you don't have the same surprise factor as you did before. So that's why I think investors will continue this unwind trade.
This is a very confusing market to me because on one hand, I believe in the sort of unwind story and then it doesn't seem so pernicious. It's just basically taking chips off the table, cashing in just technically for risk adjustment. On the flip side, I want to stick on American Air for a second, and I'm not asking you to comment specifically on this airline. But the fact that the shares are down so much, even after, as Jon was mentioning, being punished all through the year, it is down 26% year to date, really suggests that we're coming off really low expectations and still getting punished when earnings disappoint. Doesn't that reflect this feeling of sort of the unknown of how much and how quickly growth is weakening?
Yeah, but I think the expectations were probably not low enough coming into this quarter. If you think about how much the expectations typically get revised down, it's let's say 3 or 4%. This time around, they got revised down by all of 0.5%. So I don't think we really reset the bar substantially lower, and that's why going into the reporting season, one of the things we've been flagging is there's likely this disconnect that's building between the earnings expectations and what's happening in the economy. And if you look at the economic surprise index, it's been negative for quite some time. If you look at the U.S. consumer, Lisa, I think I'm now maybe finally joining you in that camp, that there's a weakening in the U.S. consumer, and there's the unemployment rate that did go up from 3.4% to 4.1%. That's not something to disregard. So I think that's the squaring that we have to do in the markets, is acknowledge the fact that earnings expectations were too high for the economic growth that we have today.
What does that mean for how bullish or bearish you are on, say, tech stocks, which you used to really love and you used to lean into? You said you can't just throw them out because everybody loves them.
Yeah.
At this point, are you looking to buy? Is this sort of a buyable dip, or is this something that you stay away from because you don't want to get in front of a freight train?
I think you don't buy just yet, or maybe you buy very slowly, but with the idea that this is likely to play out over the coming months. And the reason I say that, Lisa, is there's this Gartner's hype chart that I'm sure a lot of us and a lot of viewers have seen, and you go through this peak of inflated expectation cycle, and what's on the other end is actually the trough of disillusionment. And I'm not saying that we're necessarily going that way for all of the AI stocks, but I think for some of them we likely are, or it's going to take longer to monetize the AI that we were all so excited about. So that's why I think that part is going to take a little bit longer to play out. The other part is just given how long investors have been some of these artificial intelligence stocks, I think there's still a lot of selling pressure that is likely to come forth. So that's why I would think about having a shopping list, but executing that shopping list probably over the next few months. The other thing, too, the markets typically consolidate into the first, or I should say after the first rate cut. So whether it's July, whether it's September, the markets 3 months after the cut tended to consolidate. Information technology, if you use the 1995 cycle, for example, as a soft landing scenario, Infotech rallied into the first rate cut, but again, it's sold off or consolidated after. So that's why I don't think it's a quick buy the dip here in technology, but think about it as more of a protracted, let's say 3 months consolidation frame.
Given you've now come on to Lisa's side about these concerns in the consumer, where will that play out in the market? If consumers aren't spending, what does that mean for potentially stocks you want to go in on or pull back?
First of all, what I would say, the consumers are spending, right? But they're not spending as much as they used to. If you look at credit card spending data, for example, if it was up 7 or 8% year over year, now it's maybe 3 to 5%, depending on what kind of a consumer you look at. So I think it's a slowdown story versus a recessionary consumer spending print. But I will say, Anne-Marie, that one of the favorite trades that I have in the market today are the rotation trade, which is the other side of that technology trade, which is going to things like regional banks, for example. So, so it's probably not as levered to the consumer as it is to the commercial real estate market, for example, but regional banks are really levered to lower interest rates. I think the one certainty that we have in this market environment is the Fed is likely to cut rates, if not this month, then probably in the next couple of months. And if that's the case, you want to go to those rate cutting beneficiaries. If you have lower rates, then some of those unrealized losses on the balance sheets of those banks should maybe become less so than they were before. If you have lower rates, you should also have better income margins, net interest margins for those banks. So that's where I would be looking to position in regionals, in small caps, and utilities, which all of those sort of avoid the consumer.
Smalls outperforming this morning. Equity futures on a Russell up by about 0.2%. Just an observation, more and more people sort of shift into Ramo's camp on the consumer. You notice that? They always pointed you. They're like, I'm in your camp now.
Sort of like,
it's like you run the camp.
I run the camp of sort of vague pessimism and sort of gloom and doom. I think about the 60-40 on Sebastian Page's allocation committee, and basically the bond people are on one side, the equity people are on the other side, and there's sort of a cloud hanging over bond people, and equities are like,
without a doubt, you are a bond person. Anastasia Amoroso of iCapital. Anastasia, thank you. So here's the latest. Donald Trump ramping up his attacks on Kamala Harris, criticizing her record as San Francisco district attorney and her stance on abortion rights. Harris taking aim at Trump and the GOP's ties to Project 2025. Libby Cantrill of PIMCO saying this: while Trump remains favored to win at this point, his chances, as well as the odds of a Republican sweep in Congress, are now lower than they were just last week. We now view the election as more dynamic, with likely more twists ahead. Libby joins us for more. Libby, I can't imagine what those twists might be, so let's not even entertain that. I've got a poll in front of me. It's just dropped, so allow me to share it with you. It comes from Emerson College, and it reads as follows. It's on swing states. In Arizona, 49% support for Trump, 44% for Harris. Georgia, 48% support for Trump, 46% for Harris. In Michigan, 46% for Trump, 45% for Harris. Pennsylvania, 48% for Trump, 46% for Harris. Wisconsin, they are tied in Wisconsin at 47% support, Harris and Trump, respectively. When we start to get polls like that, more polls like that in the coming days and weeks, how much weight do you put on them in the early days and weeks of this contest?
Yeah, so I would say that not a lot right now. I think that the polls will be much more telling if, after the convention and then really in September. And this is what we have been telling clients even before all this drama, is that really wait until September, because that's when just statistically polling becomes more predictive. Obviously, polling's never going to be completely clairvoyant in terms of who actually shows up to vote, but it becomes more predictive as you get closer. So, and I say especially this because it is so dynamic, because she really is reintroducing herself to voters. That's good and that's bad. I mean, she has a very progressive record that she ran on in 2020 that she's going to have to sort of defend and clarify and what have you. But I wouldn't necessarily, I would take all of this polling with a big grain of salt. So really, after the convention, really wait until September. I always tell clients, like, have a cocktail, go to the beach, enjoy your vacation, and then come back to politics in September, because that's actually when I think it's really, what will be much more indicative.
It's hard to have a cocktail given the past few weeks that we've been dealing with in U.S. politics, but now there's a lot of emphasis on who she's going to pick as her running mate. Who do you think is best for her? Not just to support her and expand her views, because you say she is very progressive, but also the math when it comes to Electoral College.
Yeah, and so, I mean, is she very progressive? We don't know. I mean, just to clarify, I mean, she ran on a very progressive platform when she was running the Democratic primary. Yeah, yes, no, and again, she was running for national office even when she was in the Senate. So for sure, she has a progressive record. I think that's the thing, though, it's unknown about her, is where does she stand on many of these issues? But you're absolutely right. Her running mate is going to be a really, really important, both because it is sort of the first public decision that she is going to make, and oftentimes, you know, picking your running mate is really a reflection of the top of the ticket's judgment, but also, as you talk about, is really the Electoral College strategy. Arizona, as Jon just said, I mean, she's lagging in Arizona. Mark Kelly, the senator from Arizona, who's more moderate, particularly on border issues, that's going to be a big liability for her, but also could help shore up support in Arizona. And then Pennsylvania. I mean, of all those 6 states that you just mentioned, Pennsylvania is going to be the most critical state for if Democrats are going to win. They have to win Pennsylvania, and it's necessary, but it's, you know, necessary but not sufficient. I mean, they will have to win other states as well. But if they lose Pennsylvania, Democrats have lost this race. So Josh Shapiro, the popular governor, who also has a more moderate stance on things like fracking,
which she had said she was going to ban. So
yes, no, exactly. And she says she's talked about Medicare for all. She's talking about defunding the police. She's talking about banning fracking. I mean, again, she has a platform that will be untenable for her to run on and win. And that's why I think she will need to start clarifying much of that. Now, the other challenge is that she's vice president and current sitting vice president, and she can't necessarily distance herself so much from Biden as well. So she has a lot of challenges, a lot of twists and turns ahead in terms of really navigating like the policy front.
You said the top of the ticket is the judgment of the candidate. What does that say about Trump and his pick of J.D. Vance?
Yeah, well, as we were just talking about, I mean, this decision to pick J.D. Vance was really a moment in time, right? It was on the heels of the assassination attempt. It was when Biden was still in the race. It was when folks had odds of Trump winning at 75, 80%. Republican sweep looked more likely than not. And so he wasn't necessarily as concerned about expanding his voter base. He wasn't as concerned about it as being tight as it might end up being. So, you know, we'll see whether he, you know, how he feels about that J.D. Vance, but it is much more a doubling down on kind of MAGA and on Trumpism than, say, a Doug Burgum or even a Marco Rubio or certainly a Nikki Haley, some of the other folks who were in the mix.
So you note that Michelle Obama is still not going to be the nominee for
I
the
saw
Democrats.
that in the notes.
Okay. So sorry to break it to you.
Hold on a second. Well, but hold on a second.
I wondered who that was for.
Okay, evidently that was for us. But I'm not going to ask you about Michelle Obama. I don't think that I was the genesis of that. I do want to ask you, though, about the tenor of the discussions that you've been having with clients overseas, outside of the U.S., how they're viewing this, how that affects their investment decisions, what questions they're asking to understand the potential ramifications of this.
Yeah, so actually, I'm still getting questions about Michelle Obama from our Asian clients and about Jamie Dimon. So, you know, hope springs eternal, I guess. So I would say they're sort of in 2 lanes. One is around fiscal, and of course, a lot of our clients overseas have a lot of dollar and a lot of treasuries exposure. So just trying to navigate that. And I think, as we've talked about, really the punchline here is that the deficit is the biggest loser in November. So regardless of who wins, the deficit will remain high. And not only because there might be new spending and there might be more tax cuts, although I think that's going to be difficult just given where deficits are right now, but mostly because, as we've talked about, there won't be entitlement reform, and that's what you really need in order to, you know, to consolidate sort of the budget and what have you. And the other concern they have is, of course, around geopolitics. And interestingly, mixed views here, because I think a lot of folks in Asia think that, well, at least President Trump, we can negotiate with him, whereas maybe a Biden or Harris may have more of an ideological view. So I'm not sure that's right. I mean, again, I think the direction of travel here around tariffs, around export controls, around even capital flows, around scrutiny around how U.S. investors invest in China is going to be sort of pervasive regardless of who wins. So in some ways, you know, my view is there may be fewer distinctions than folks think, but that's really where our clients are focused.
The message from PIMCO: get a cocktail, enjoy the beach.
Yes,
sort of reconvene
that's
in
what she
September.
tried last week. How'd that work out?
Yeah, I mean, not well, I will tell you. Yes, this is what I'm trying to do. It's sort of self-soothing, but it's not really working out very well.
Thank you. I like that advice.
Libby, it's good to see you. Thank you.
Thanks.
Libby Cantrill of PIMCO on the latest. to big tech, higher spending on AI programs and computing needs at Google parent Alphabet, prompting a sell-off in big tech stocks. As investors look for more return on AI spending, one area companies are investing heavily is in data center capacity. Waldemar Szlezak is the global head of digital infrastructure at KKR and says two megatrends are driving the demand for data center capacity: migrating data to the cloud and the rise of AI. Waldemar joins us now for more. Waldemar, good to see you, sir.
Thanks for having me.
Thank you for being here. Let's just talk about what is digital infrastructure. Let's start there, super simple. What are we describing here?
Yeah, it's a great question. I mean, I think to us, digital infrastructure really has three big pillars. There's mobile infrastructure. Traditionally, think of it as towers, telecom towers. There's the fixed line infrastructure, so it could be fiber that delivers connectivity to homes or enterprises. And of course, I think the topic we're about to discuss is cloud sort of storage and computing infrastructure, right? i.e. data centers, most pronouncedly. So those to us are the three big pillars, at least how we define digital infrastructure within KKR.
So let's talk about the investment opportunities and how much is going to be invested over the next several years. I want to reflect on a quote that came from the Google CEO, the Alphabet CEO, in the last couple of days, when he said the biggest risk here in a cycle with a theme like this is under-investing and not over-investing. I sense from your perspective you're going to agree with that stance. Am I right?
Yes. Yes.
Why is that? Why is this such a big moment? And why is that the right way to look at the balance of risks?
Well, I think let's look at the computing piece, right, of it. I think two mega themes that we have are obviously under computing and last mile connectivity. And I think maybe we'll touch a little bit later on Metronet, which is a deal we announced yesterday in partnership with T-Mobile. But focusing on data center piece, I think if you look at United States and say, what was the infrastructure, what was the spend to help facilitate the build out of internet infrastructure or cloud infrastructure? So 16-year cycle from 1990 to 2006. 2 gigawatts. No longer do we think about data centers in terms of square feet. It's really about the amount of power that the data centers have. So that's an important factor there to consider, and we'll touch on that in a second. So internet infrastructure, 2 gigawatts. The next phase was Internet 2.0 and cloud, 8 gigawatts, about 15 years. Technology cycles have accelerated. So we're now talking about AI build-out, cloud 2.0, Internet 3.0 as a 5-year cycle, and 25 to 30 gigawatts of power required to fuel this. So I think you had a more patient, sort of highly visible investment cycle that's now gotten compressed, and perhaps is creating, I think, scaring some of the investors out there.
Well, some people would argue that this might be one big reason for the sell-off we've actually seen in big tech. There was one investor who said this in a recent story: the overarching concern is, where is the return on investment in all the AI infrastructure spending? It'll pay off in a few years, but it's not going to come anytime soon. That is what the fear is. Waldemar, how much are you seeing near-term returns on some of these infrastructure projects that a lot of people would agree may be crucial in, say, 10 years?
Yeah, I mean, I think it's a great question. I would draw an analogy to similar questions raised during the build-out of cloud in 2006 and 2007. So, when Amazon really emerged as the cloud provider in 2007, I think similar questions were raised about where is the ROI. A tremendous amount of investment is needed to help facilitate the build-out before you actually start seeing the applications of that. And if you fast forward 2007 to today, Amazon stock is up almost 3,000%, right? And it's been forgotten. So I think the concerns are valid. I do think that there's frothiness in parts of the ecosystem. Within digital infrastructure, at least how we're positioning ourselves, we don't see that. Most of the capacity on the data center side that's coming online is fully leased. Most of it is leased to the large hyperscale customers. So the type of risks that we're looking to take, we're not necessarily exposed to perhaps some of the volatility. But I think it's a fair question to ask. What is the ROI? I think AI will be larger than potentially cloud. If you think about it today, cloud business is about a $500 billion business annually, investing almost $200 billion to build that infrastructure. I think the view is that this feels different than late 90s, perhaps, bubble.
That said, you said that there are certain pockets that feel frothy and certain pockets that seem very worthy. What are those pockets? How do you distinguish the two?
Yeah, I mean, that's why I think we're trying to figure that out. So a big part of what we're doing at KKR is really trying to map the entire ecosystem from the silicon side, which is, I think, we're talking about chips, to the ultimate endpoint of applications layer and trying to figure out how do we participate to the different strategies that we have within KKR. We're not a venture investor, so we're staying away from that. An interesting point I would make, in 1990s, a lot of analogies are being drawn to the 1990s tech bubble and bust. There were 38 or 39 stocks in 1999 that were up 100% in a year. Today, there's only one. So public markets, perhaps there isn't as much of a frothiness. Private markets, there's $15 billion of capital that has gone from venture capital funds into generative AI platforms. That's 10x the prior trend line. So I think perhaps there are parts of frothiness in the private markets versus the public markets. But I think we think of it as a long-term trend, sort of an industry 3.0, if you think about it in terms of long-term 300-year sort of a cycle. And we're pretty confident that we're still in early innings of that.
When you look at the investment, is it actual market demand, or some of this has to do with the fiscal push coming out of Washington?
It's fundamental market demand. I think we're seeing government part of this investment has not played a large role. Now, we think that in the long term, I think a comprehensive solution which includes private capital, includes obviously a combination of the tech companies, intervention from some government policies to help facilitate the build out of some of this power infrastructure, which ultimately is a key component of this, will be required. From a KKR perspective, we think of it as we're pretty uniquely positioned to ultimately play a major role in that.
So you just announced a deal, and It was actually not on highfalutin cyber prowess in artificial intelligence. It was in medium-sized, smaller cities getting connectivity, basic connectivity to the internet, to the cell phone. How far behind are we in basic infrastructure at a time when we're trying to build out a massive network?
Yeah, so two mega themes. We touched on the cloud computing. The other big theme we have is fiber to the home. We've made over 10 investments globally, over $10 billion of capital just in the fiber to the home strategies over the last decade. We're pretty bullish. We think this is pretty important. So in the US, about 50 million homes still don't have access to full fiber. We think that that's unacceptable and that ought to change. And so Metronet, which is the deal that we announced in partnership with T-Mobile, it's really meant to help facilitate the growth of that and really bridge the digital divide, not only in the sort of the, as you call it, the smaller cities, which, by the way, a smaller city in the United States called sub 50,000 population center has about the 1/5 of the speeds that you see in the major urban areas. And even in major urban areas, it's pretty inadequate. So I do think that we believe that there is a large decade-long investment cycle to help build out fiber infrastructure in the United States, and we're really happy to be part of it and happy to partner with a premier telecom operator like T-Mobile to do that.
You need to come back soon. We've only scratched the surface, haven't we? This was great. It's good to catch up with you, sir. Appreciate it.
Would love to.
Thank you. Waldemar Szlezak there of KKR.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.